Hi guys, and welcome to Symax Fintech weekly report. Uh, so I just thought I'd introduce myself. So I am Chris Tubby. I'm not going to appear on all the slides because to do that I'm going to cover over some of the charts and some of the words. So it's just to introduce myself so you can actually see I'm real. So for the better or for the worse. Anyway, so you won't see me for the rest of the slides, but nice to meet you, and I hope you enjoy what we do, and we'll hopefully see you soon again. So now we'll get on with the analysis. First of all, as usual, I just want to take you through our disclaimer. So trading involves the risk of loss of capital. It's not suitable for everyone, although, as I always say, hopefully it is for you guys. As many companies provide leverage, just be aware that you can lose substantially more than that initial investment that you make. And the views, opinions, information contained in these is just provided solely for educational purposes. You know, we're not trying to encourage you to invest or trade. That has to be your decision. Of course, carefully consider the risks, your financial situation, your level of experience, and of course your risk appetite. And of course, again, you should only risk capital you're prepared, but more importantly, that you can afford to lose. If you've got any doubts whatsoever, seek some independent financial advice, and do that before you start risking your capital. Okay, so first of all, we're going to look at what happened last week. So in the US, headline inflation data was a little bit lower. The peaked at 9.1 for the moment, down to about 8.5%. But still high. It's still going to cause the Fed to do something at their next meeting, but that's not till September. So they get the luxury of seeing more data yet before they have to make that decision of how big that next rate rise is going to be. The core inflation was unchanged at 5.9%. And as pro traders, we focus a lot on the core inflation, core CPI, core PPI, rather than just the headlines. Michigan consumer confidence was higher again at 55.1. The US still seems to be in a really good position. Whether it's going to suddenly turn or not, I really don't know. Biden's latest Build Back Better program passed. He's got to sign it this week, I think. But, again, is that going to be inflationary because he's expanding? There's more stimulus coming through. It's just a matter of where that money's being spent. And some of it's in good places for sure. Gasoline's back below $4 again. So that will please everybody in the States because obviously it's driving season there for the summer. Musk sold more Tesla shares, another $6.9 billion worth. His point is that if he's forced to buy Tesla, he wants to make sure that he's got enough cash in case of any of the guys that or companies, institutions that was prepared to invest with him decide to pull out. If not, then wonderful. Look at all that cash he's got. I think it's over 30 billion now he's got sitting in the bank. And of course, he's managed to sell a lot of Tesla shares without upsetting the rest of the shareholders because he's been able to justify why he's been selling those shares. And of course, Donald Trump's offices got raided as well, and lots of documents taken away. Now, why are we mentioning Trump? Because we've got the midterm elections coming up soon in November. And, Trump could come back into the forefront there. If the Republicans do well, then, Biden's going to probably spend the next 2 years not being able to get much passed. It's just problems we have with the way politics works, I would say. And that's not just in the US, but pretty much around the world. In the UK, GDP was down 0.1, but consumer confidence was lower as well. the UK is not in a good place. I live here, so I'm telling you. With electricity prices, food prices, inflation, and inflation here hasn't finished yet. Where in the US it may have peaked, we've got more to come in the UK because we've got price caps on our electricity, which are going to be going up in October and again in January. We could see inflation peak at something like 13% early next year, and it's going to be a challenge for the Bank of England on how they manage this because it's taken away a lot of families and households' disposable income. Europe have similar problems with energy prices remaining high. Overall, it's still not that much that's changed. Gold was steady, around about 1800, give or take a little bit. Commodities were bouncing back as well. Stocks are up again. Sometimes bad news is good news. Sometimes good news is bad news in these markets. But investors are comfortable being back in. We seem to be, I think it's about 10% off the lows now after we had that big sell-off from the beginning of the year. So, what I would say at the moment is keep an eye on some of the small cap stocks because they're much more sensitive to consumer spending. So they could give you a little bit of insight into what's going on next. Okay, so now we're going to look at key data for the coming week. Biden, I would expect to sign his program into law. It just gets passed, so the money can start flowing. All those billions that's going into this, into the chips, so sciences. It's going to be for health. So there's lots of good things in there. But a lot of it's about infrastructure. A lot of it's building, creating this amazing semiconductor industry within the US, so they don't have to rely on outside countries anymore for that, because obviously that has been damaging to many countries' production for a variety of things, because obviously there's chips in almost everything these days. In the US, we've got manufacturing, housing, retail sales, business inventories, and the FOMC minutes coming out. In the UK, earnings, employment, CPI, PPI, retail sales. Keep an eye on those retail sales. Are we really spending as much as everybody thinks we are? For me, I've got a feeling that instead of the main focus being on sort of products and all that, I think it's more on services at the moment. But we'll have to wait and see as that data comes out from various countries. And then the EU, in Germany, we've got the ZEW, and then PPI, and then there's GDP coming out. China, keep an eye on that because some of that's going to be out already, which is retail sales, industrial production, new home prices, and their rate decision. Again, new home prices are going to be a little bit important there because, people saying that they're not going to pay their mortgage or rent on their homes because they're not finished and such like, and that's caused some problems there. And the builders have been in trouble as well over sort of the last year or so, I would say, in China. In Japan, we've got GDP and trade balance. Keep an eye on the trade balance for the yen. So macro outlook, not changed very much, but little bits and pieces, hopefully positives, but let's wait and see. US a little bit softer with their inflation, around about 8.5%. Possibly it's peaked, but we're going to have to wait and see. And as I mentioned, with the Europe and the UK, possibly there's more inflation to come because of those energy, electricity prices. Shrinkflation is still with us. Stagflation is potential. Recessions are around the corner, I would say, for some countries, possibly most by maybe the end of next year. We'll have to wait and see. I don't know. I haven't got that crystal ball. It's just my assumption, the way I look at things at the moment. If central banks get too aggressive with these rate increases, consumers households are already under a lot of pressure with their spending, let alone having to pay more out for loans, and such like. And those people that have the luxury of having some money are probably feeling a little bit happier because they're actually getting to see a return on that money. Supply chains still, there's still issues. They are improving though, or they seem to be improving. And we've got a few months to go before, we'll find out if COVID's going to really come back, and if it does, in what form it's going to come back, which again could then start to change things. And again, that comes to China with their zero tolerance, etc., for COVID. So let's wait and see. Consumer demand is reducing, households less disposable income, and that's for the low and mid earners. Even though they're getting paid a little bit more money, they're getting these rises or they're moving jobs to get more money, inflation's running away, and the increase is not necessarily covering that, especially as it's the essentials, food and energy, the two main ones. Energy and food prices are higher, with grains up again. As I mentioned, gasoline though below $4. This is the 59th consecutive day of decline for gasoline prices. And of course, that's going to please Biden, because that's going to be something that's really in people's mind at this time of year in the US, the voters, because they travel around, it's driving season. With EU, gas prices are high. Again, that sort of hot summer at the moment. We are seeing high temperatures in Europe. And of course, that steadied the price of oil as well, because it will be used as an alternative to gas where it's possible. But Europe and UK need to be looking at alternatives to gas, especially Russian gas, just because there's no guarantee of supply anymore. We're still seeing that lack of workers. Earning pressure remains there at the moment, although, I do expect to see the people trying to get back into work. As we saw with NFP the week before, 300,000, over 300,000 of the people that found new jobs were women. So it's that because households are stretched and they need that second income. Again, something to look into. Now, some countries are heading for recession, and that that could be the US as well next year. And if you see that, then these stock prices are high. How far they'll come off, we'll have to wait and see. But of course, if there isn't a recession, then it's not going to happen. But if there is a recession in the US, I mean, you could see the S&P drop something like 1,000 points. Again, just remember, this is just me. This is just my opinion at the moment. The way I'm looking at the markets, it doesn't guarantee anything. USD was steady, with yen and the pound and the euro being vulnerable. And, I think that that's going to continue. I don't see that changing this year. The pound and the euro, obviously with inflation and being that much closer to the Russian-Ukraine war, which is impacting us locally much more. On the UK front, we've got GDP was slightly better than expected. Inflation's yet to peak, as I mentioned, because of those electricity caps that are set to rise in October and January. And of course, this is going to push the Bank of England probably to set for another 50 basis point increase. But again, there's no guarantee that's going to be that. It could be 50, it could be more, it could be less. It depends really how these central banks continue. Jackson Hole, as I mentioned, this is a symposium. This is where all the economists and the central bankers all get together and discuss the global economy, what they're doing, what they expect to happen, etc., etc. And that is from the 25th to the 27th of this month. And home sales are dropping, as you would expect, and that's because obviously there's rate rises and it's making it more challenging for people to be able to afford to move.